Hi everyone, I'm Paul and welcome to my review of ICT's 2022 YouTube Mentorship Program Lesson 11. Today's video is going to be a bit shorter than usual and it's a bit of a teaser for Lesson 12, which is a deep dive into market structure. As always, make sure you thoroughly review ICT's videos and make sure you subscribe to his channel. I've put a link in the description so you can easily find it. So please like, subscribe and let's jump into today's video. Today's video is Lesson 11 of ICT's 2022 Mentorship Program. Just a short video today, but our outline is basically going to cover swing high and swing low patterns. Then we're going to do an introduction into market structure using a trade example from the 21st of February that ICT posted on his community page. Starting off with swing high and swing low patterns. Now we've covered these in other videos before, but given that we're going to talk about market structure in more detail, particularly in lesson 12, I thought it'd be a good idea to cover swing high and swing low patterns in a little bit more detail in this video. So starting with our swing low pattern, our swing low and swing high patterns are both 3 candle formations. So obviously with a swing low, the middle candle, the low is going to be lower than the candles to either side of it. So you can see this low of this candle is lower than the one to the left, and it's also lower to the one to the right. Keep in mind that a swing low pattern can either be a long, intermediate or short-term low, and the abbreviations we're going to use just for simplicity going forward in the video series is LTL for long-term low, ITL for intermediate term low, and STL for short-term low. And as you'd expect, the opposite is true for a swing high. So it's our 3 candle pattern again, and the high of the middle candle is higher than the highs of the candles each side. So you can see the high of this center candle here is higher than the one to the right, and it's also higher than the one to the left. And again, these can be a long, intermediate or short-term high, and the abbreviations we'll use for that is LTH for long-term high, ITH for intermediate term high, and STH for short-term high. We'll start off today's video looking at the daily chart, and specifically looking at this area of the NASDAQ that we've been covering in many of the other videos. So this is the daily chart from about the 24th of January all the way to the 22nd of February. And you can see from this low to this high, we've had this retracement. And if we run our fib from that low to this high, we get our discount and our premium zone. So you can see the market traded into that discount. So we actually had sell side liquidity over here, which this move took out. And the market then traded higher back into this premium zone. You can see we came back towards equilibrium, traded down here, back up into a premium market again before coming back into a discount. And you can see that's where this big powerful candle here was, which is what's created that fair value gap, which I've got in the pink box just there. And you can see that move, that downward move was quite powerful. It breaks market structure here. So we have sell side liquidity here. So it breaks that low, creates our fair value gap. So remember, that's our 3 candle formation. So our first, second and third candle, and the fair value gap is formed between the low of that first candle and the high of that third candle. So you can see the market trades back up into that fair value gap. It doesn't quite fill it. It isn't actually completely filled until this candle here, and this candle, it trades the whole breadth of that fair value gap and completely eliminates that imbalance. The next candle trades downwards and we go back down into a discount market here before the market keeps trading lower. And you can see as the market trades lower, it takes out this sell side liquidity on the way down before taking down the sell side liquidity from this bottom of the range low here. And if you've been watching ICT's videos, you'll note that he was suspecting all through this move that price would come back and it would revisit and take out this sell side liquidity. So that's exactly what happened. If we zoom into our 1 hour chart, we can see the fair value gap from the daily chart superimposed here onto the 1 hour chart. So you can see how the market traded down and then it traded back up into this fair value gap. And you remember from the daily chart that we basically completely eliminated the whole fair value gap before trading lower, and that's exactly what you see here. So we fill in the whole of that fair value gap before trading lower, and then we come into the 21st, which is the session that ICT trades on and which is the topic of this particular video. So you can see this is the area of the 21st just here, and the interesting thing about the 21st is actually a bank holiday, and you can see the gap here where the market closed before it reopened, and you can see there's quite a significant gap there and an acceleration lower. So we'll drill in now to the 15-minute chart and start to step through the actual trade that ICT took on the 21st to take advantage of this particular move. So if we zoom in now to our 15-minute chart, you can see I've marked out the session here with midnight New York time and then 8:30. Now, one of the things to keep in mind is that ICT often refers to the open sometimes as midnight, sometimes as 8:30. So when we're referring to the entire day range, that's when we would be using midnight New York time as the opening price. And if we're just referring to the morning session, then that's when we'd only use the 8:30 opening price as our marker. So in this example, we're looking at the New York session in the morning, so we're using 8:30 as our reference price. So you can see I've marked the opening price here. Now we have a bearish bias, we're expecting lower prices. You can see our sell side liquidity is marked here. So we're expecting price to draw towards that point. And so in terms of entering our position, we want to be entering somewhere between the open and the high, and obviously as close to the high as we can for this part of the morning session to get set. Now in this particular trade, ICT gets set here at about 10:30, a bit later, I think it's about 10:33, and then he exits here after the market reopens, after it shuts for the bank holiday. You can see this big candle here where it wicks down, and he gets out down here. So that trade's well over 200 points. So that's a very impressive and thoughtful trade, obviously taking advantage of his bias and knowing that the market is going to close, expecting a gap and then probably a wick down. It's a very thoughtful and very well laid out plan, and you can see it's really paid off handsomely for him. So looking now at our 5-minute chart, we've got our opening price here with this blue line. And so remember, we have a bearish bias, so we're expecting lower prices, and we'll expect price to be drawn down towards this sell side liquidity down here. So whilst we have a draw in liquidity to the downside, we get this morning rally into 9:30. Now this rally is just designed to lull traders into a bit of a false sense of security before we have the market trade lower. So you can see here at 9:30 we have this fair value gap formed. So that's our 3-candle formation. I've marked it here with this purple box, and you can see price trades down, doesn't go below the opening price, and it just trades in and about that fair value gap. So you can see these candles very neatly fill in the fair value gap, and it might wick above and below the fair value gap. We're not really too worried about that, but you can see the candles really respect that fair value gap before the market trades lower. You can see it takes out this sell side liquidity, creates another fair value gap in the process, and then the market trades back up into that fair value gap. It only really just touches it before it starts to trade lower. You can see we have that gap from where the market shuts for the bank holiday. It then gaps when it reopens and trades significantly lower. So it goes straight across that sell side liquidity that we're aiming for and ends up trading significantly lower. And as I mentioned before in the video, down here is where ICT gets out for about a 200-point trade, which is pretty remarkable. So the thing you'll note from this particular setup is ICT trades just here where I've highlighted this candle in yellow. So it's not quite here, it's about 10:33, and he trades just as price just touches at the top of that fair value gap. And so this is where we start to get an introduction into the way that ICT looks at market structure. And as you probably already noticed, is it's not just about higher highs, higher lows, and that sort of thing that you see in most sort of videos about market structure. It's much more detailed than that. So I'm not going to go into lots of detail in this video because we go into a lot more detail in lesson 12. But remember, from earlier in the video, we talk about swing highs. And so that's these patterns that we have here. So we have short-term highs, intermediate term highs, and short-term highs. The thing that delineates an intermediate term high is it has a short-term high either side of it. And the other thing that can delineate an intermediate term high is one that fills in a fair value gap. And so that's what we have here. And then it has short-term highs to the side of it. So as I said, I'm not going to go into much more detail than that in terms of market structure because it's far more detailed. This is really just a bit of a taste. And so I guess the question is then, how did ICT know that he could go short here prior to this fair value gap here? And why was this particular place? And why was he confident that price wouldn't go higher and wouldn't trade back through that fair value gap? And so quite simply, it's because this intermediate term high is now lower than this one. And we also have this short-term high, which is lower than that one. And so that increases the confidence that price is not going to go above this intermediate term high, and we'd expect the market to then trade lower. And what makes this particular entry, optimal is that it's above the opening price, and you can see it's quite close to the high that's created at the beginning of the session. So obviously, if you didn't actually get set in this particular fair value gap, you could have gotten in at this one, and this particular setup would even be higher confidence because you can see that candle was quite powerful. This is that displacement candle that ICT talks about, which takes out this low here, taking out this sell side liquidity before just trading back up into it, so that you would have a high level of confidence in this particular setup, but you're obviously sacrificing a little bit of additional upside, which you would have captured in that whole trade. In today's video, we examine the characteristics of swing high and swing low patterns, and then we dipped our toes into market structure using a trade example from the NASDAQ. I'm already working on lesson 12, which is a real deep dive into market structure, and you definitely don't want to miss that video. If you found today's video helpful, it'd be great if you could like it. That helps other people to find it. And if you enjoyed today's video, make sure you subscribe to my channel to see other videos like it. Thanks for watching, and I'll see you in the next video.